Let me give you the conclusion first. A 7% to 10% pullback in the US market over the next 6 months would actually be completely normal. And honestly, it probably has very little to do with who becomes the next Fed chair. Recently, a chart started going viral online. It claimed that every time the Federal Reserve changes leadership, the stock market crashes shortly after. Sounds convincing, right? But I went back and tested the data myself, using US market history going back to the 1950s, and the conclusion was simple. There's basically no strong evidence supporting that idea. In fact, the chart itself was misleading. It mixed together 6 months declines, 12 months declines, and even longer term crashes, then labeled all of them as market drops after a new Fed chair. Take Powell, for example. When he became Fed chair in 2018, the market did not collapse the way that chart suggested. And here's the important part. Historically, a 7% to 8% pullback is already normal for the US market, even without a change in Fed leadership, because markets are driven by inflation, economic data, liquidity, and expectations, not just one person. That's why retail investors often get trapped by stories. A headline appears, and suddenly people think everything has changed. But data and emotions are usually very different things. If there's another market theory you want me to test with real data, drop it in the comments.